Hey traders, welcome back to the channel. Did you know that a staggering 90% of Forex traders lose money? It's a harsh reality, but it doesn't have to be your story. Today I'm going to pull back the curtain and show you the exact strategy that smart US traders use to stay profitable. Strategy that is simple, effective, and perfect for beginners. If you're serious about learning Forex trading step by step, using a method that actually works in the US market, then this video is for you. Forget the get-rich-quick schemes and the complicated indicators. We're going back to basics with a powerful approach that can transform your trading journey. So, let's get one thing straight right from the start. Successful Forex trading isn't about having a crystal ball or guessing which way the market will go next. It's a game of probability, discipline, and intelligent risk management. While most beginners are chasing every little market wiggle, hoping for a lucky break, professional traders are doing something entirely different. They focus on three core pillars. First, rigorous risk management to protect their capital. Second, identifying high-probability setups where the odds are stacked in their favor. And third, having the patience to wait for those setups to appear, rather than forcing trades that aren't there. This mindset shift is the single biggest difference between the 90% who lose and the 10% who consistently profit. Your goal isn't to win every single trade. That's impossible. Your goal is to have a system where your winning trades are bigger than your losing trades over time. That's how you build a long-term, profitable trading career.
So what's this simple strategy that can help you join the ranks of profitable traders? It's a classic for a reason. It's called trend following combined with support and resistance. This is one of the most reliable and easiest to understand strategies for anyone new to the Forex market. It's based on a fundamental market principle. Prices tend to move in trends, and they often react at historical price levels.
By combining these two concepts, we create a powerful filter that helps us identify high-probability entry points and avoid a lot of the market noise that traps beginners. We're not trying to reinvent the wheel here. We're using a time-tested method that has worked for decades. And today, I'm going to break it down into simple, actionable steps that you can start using right away. The first step is to identify the overall market trend. This is your North Star. It tells you which direction you should be trading. As the old saying goes, the trend is your friend. For this strategy, we're going to use the higher time frames, like the 1 hour, or H1, and the 4 hour, or H4 charts. These time frames give us a clearer picture of the market's main direction and filter out the short-term noise you see on smaller charts like the 1 minute or 5 minute. So, how do we identify a trend? It's simple. In an uptrend, the market will be making a series of higher highs and higher lows. Each peak is higher than the last, and each trough is higher than the last. Conversely, in a downtrend, the market will be making lower lows and lower highs. If you see this clear structure, you've identified your trend. If the market is moving sideways, without a clear direction, it's a ranging market, and for this beginner strategy, we stay out. Our rule is simple. If the H1 or H4 chart is in a clear uptrend, we will only look for opportunities to buy. We ignore all sell signals. If it's in a clear downtrend, we only look for opportunities to sell. This one rule alone will dramatically increase your odds of success. Once you've identified the trend, the next step is to find our entry point. We don't just want to buy anywhere in an uptrend. We want to buy at a discount. We do this by identifying key levels of support and resistance. Support is a price level where buying pressure has historically been strong enough to overcome selling pressure, causing the price to bounce up. Think of it as a floor. Resistance is the opposite. It's a price ceiling where selling pressure has overcome buying pressure, pushing the price back down. In our uptrend scenario, we want to wait for the price to pull back to a strong area of support. This is where we look to enter our buy trade. Why? Because we are buying at a logical point where other buyers are likely to step in, giving our trade a higher probability of moving in our favor. You can identify these zones by looking for previous swing lows in an uptrend or previous swing highs in a downtrend. Look for areas where the price has reacted multiple times in the past. The more touches a level has, the more significant it is. Patience here is key. You must wait for the price to come to your level. Don't chase the market. Now for the most important part of any trade, risk management. This is where you protect your trading account. Before you even think about how much you can make, you must define how much you're willing to lose if the trade goes against you. This is done with a stop loss. A stop loss is an order you place that will automatically close your trade at a specific price, limiting your potential loss. For our strategy, if you're entering a buy trade at a support level, you should always place your stop loss just below that support structure. This gives your trade some room to breathe, but gets you out if the level breaks and the trade idea is proven invalid. A common rule for beginners is to never risk more than 1% to 2% of your total account balance on a single trade. This means if you have a $1,000 account, your maximum loss on any one trade should be just $10 or $20. This might seem small, but it ensures that a string of losses won't wipe out your account, allowing you to stay in the game long enough to catch the winning trades. Let's walk through a complete example. Let's say we're looking at your USD pair on the 4-hour chart. We notice it's been making clear higher highs and higher lows for the past few weeks. Great, we have our uptrend. So, we are only looking for buy opportunities. We then identify a strong support zone around 1.0800, a level where the price has bounced higher from multiple times in the past. Instead of buying as the price is moving up, we patiently wait. A few days later, the price pulls back and tests that 1.0800 support level. This is our signal to enter a buy trade. We place our entry order at, say, 1.0805. Immediately after, we set our stop loss. We place it below the support structure, maybe at 1.0770. This means our risk on the trade is 35 pips. Finally, we need a target. A simple way to set a target is to aim for the next level of resistance or the previous high. Let's say the previous high was at 1.0910. That gives us a potential profit of 105 pips. In this scenario, we are risking 35 pips to potentially make 105 pips. That's a 1-2-3 risk-to-reward ratio, which is an excellent setup. Now we let the market do the work. We don't stare at the chart. We've defined our risk, we have our plan, and we stay consistent. This strategy is effective because it aligns you with the market's momentum and forces you to be disciplined. You're not just randomly clicking buttons. You have a clear, repeatable process. You identify the trend on a higher time frame. You wait for a pullback to a key support or resistance level. You enter with a predefined stop loss to manage your risk, and you aim for a target that gives you a positive risk-to-reward ratio. That's it. It's not complicated, but it requires patience and discipline, two traits that most losing traders lack. Your job is to execute this plan flawlessly over and over again. Some trades will lose, and that's perfectly fine. As long as your winners are bigger than your losers, you will be profitable in the long run. Don't get discouraged by a single loss. Think in terms of probabilities over a series of 20, 50, or 100 trades. Focus on the process, not the outcome of any individual trade. That is the secret to lasting success in the Forex market. Remember, becoming a consistently profitable trader is a marathon, not a sprint. This strategy is a fantastic starting point for any beginner in the US or anywhere else. Master it, understand its logic, and practice it on a demo account until you feel confident. Don't rush to trade with real money. Build your skills and your discipline first. The market will always be there, so there's no need to hurry. Focus on solid risk management, stay consistent with your strategy, and let your profits grow over time. This approach removes the emotion and guesswork from trading and turns it into a structured business. If you found this breakdown helpful and you want more simple, profitable Forex strategies just like this one, do me a huge favor. Hit that like button, subscribe to the channel, and turn on notifications so you don't miss our future videos. And let me know you are ready to level up by commenting the word Forex down below. I read all the comments and love hearing from you. Thanks for watching, and I'll see you in the next video.